Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Warner Bros. Discovery.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Okay, so this is a really compelling one. We're looking at a company that is, trying to claw its way into the future. It's this massive legacy media giant.
Two of them really smashed together, and I think the market has been pretty skeptical that they could actually pull off a turnaround.
Right, but the story now seems to be shifting. It looks like it all hinges on three big catalysts, starting with, I think, the most important one. They're actually making money from streaming.
That is the entire foundation of the bull case right now. For years, the story was that streaming was just this money pit you had to have.
Very expensive hobby, yeah.
Exactly. But Warner Bros. Discovery has hit this critical inflection point. It really validates their whole strategy of focusing on discipline instead of just, spending billions on content.
And when you say inflection point, you're talking about the actual numbers, which are frankly pretty staggering.
They are.
Let's talk about Q1 2025. The streaming business reported, adjusted EBITDA of $339 million?
It did. And for anyone listening, EBITDA is basically a clean way to look at the operational profit of that part of the business.
And that $339 million,
right.
It's the scale of it that's turning heads, right? I mean, what was the year-over-year increase?
It was almost 300%.
Wow.
So it tells you that everything they've been doing since the merger, combining the platforms, cutting costs, it's finally showing up as actual cash, not just promises.
Okay, but, one good quarter doesn't make a year. How sustainable is this, really? They're guiding for a pretty aggressive ramp-up.
It's a huge ramp, but the forward guidance is where the confidence comes from. They're telling the market to expect over $1.3 billion in streaming EBITDA for the full year 2025.
So they've solved the puzzle.
It seems so. They figured out how to scale the service to a huge audience while being profitable. So many of their competitors just couldn't do both at the same time.
So they're focused on profit. Is that hurting subscriber growth? That was always the big fear, wasn't it? That you'd have to choose one or the other.
You'd think so, but no. They finished the third quarter of 2025 with 128 million subscribers.
And they're targeting, 150 million?
150 million by the end of 2026. That's a 22% annual growth rate, which is really impressive from this base.
Yeah.
And it's mostly coming from their international expansion.
Let's talk about that. International is always tough, right? Lower revenue per user, lots of competition.
It is, but they have a smart playbook. They had a great launch in Australia, and now they're heading for big European markets like Germany and Italy in early 2026.
And the key is they're bringing their content back home, so to speak.
Exactly. They used to license out all their best stuff, their HBO shows, to local channels. Now they're taking it back, so people who are already fans have to come directly to Max to watch. It's a much lower risk way to grow. Okay, so streaming is the growth story. But we can't forget the part of the business that's just a cash machine, the studio segment.
The earnings engine, I've heard it called. I think that's the perfect term for it. This is the old school Hollywood muscle, and it is still very strong.
Oh, absolutely. I mean, they did over $4 billion at the worldwide box office in 2025.
The only studio to cross that mark.
The only one. That kind of dominance at the theater gives you immediate high-margin cash, and it fills the pipeline for your streaming service for years to come.
And you can see that in their financial targets. Studio EBITDA is supposed to hit, over $2.4 billion this year?
That's the projection, and they're aiming for $3 billion in the medium term.
But Hollywood is so hit or miss. What makes them so confident they can keep this engine running?
It's a couple of things. One is just operational clarity. We're seeing the DC Studios reboot with James Gunn getting validated right away.
With the Superman opening, yeah. $220 million globally.
A huge signal. It tells you their biggest, most valuable IP is creatively back on track. That de-risks their future movie slate in a big way.
And that creative success is built on top of this. This incredible content moat they have. It's not just one movie.
It's the whole library. I mean, it's just unmatched. You have the global gold standard of TV with HBO. Think about the cultural buzz around The Last of Us or Succession.
That's what lets them charge a premium price.
And right alongside that, you have the huge film catalog, DC, Dune, all of Warner Bros.
Yes.
History.
Plus all the Discovery factual stuff, which is maybe not as glamorous, but it's cheap to make and people watch tons of it.
Right. That reliable volume is perfect for the ad-supported tiers. So you have this combination of premium, blockbuster, and bulk that is just, it's almost impossible for anyone else to build from scratch.
So the content is secure. But let's talk about something that's been a huge headache for all media companies: live sports.
They've handled this so smartly, they just walked away from some really expensive NBA rights. That alone saves them over $100 million in the fourth quarter.
So they're turning a huge cost center
Oops.
into something else.
Into a new asset, they're building that standalone sports streaming app with ESPN and
The
FFX.
joint venture, right, launching in 2026.
Yes. It's a massive pivot. Instead of carrying all that cost themselves, they're spreading the risk and building a new product specifically for people who have already cut the cable cord. It's very forward thinking.
Okay, let's pivot to the big one, the elephant in the room that always comes up with this company: the debt.
You have to talk about it. It's the biggest risk factor for sure. As of Q3 2025, the gross debt was sitting at $34.5 billion.
That is a gargantuan number.
It is. The net leverage ratio is 3.3x, which is still pretty high, especially with interest rates where they are today.
So it's a huge number, but context is everything. What are they doing to actually tackle that $34.5 billion mountain?
They're being super aggressive with their cash flow. They paid back $1.2 billion in Q3 alone.
Okay.
And you really have to look past the official recorded numbers because they're still messy from all the one-time merger costs.
So you need to find the underlying cash generation power of the business, the free cash flow.
Exactly. Free cash flow, or FCF, is the real cash the business has left over to pay down debt. And if you strip out those one-time costs, their annualized FCF is running over $4.8 billion.
So that's the real fuel they have to burn down that debt pile.
That's the fuel, and it proves the underlying business is actually very healthy.
And it seems like Wall Street is finally starting to notice this turnaround, if you look at the stock chart.
Oh, for sure. The stock has had a huge rally. It's up, 157% from its 52-week low?
And technically, it's formed what they call a golden cross.
It has. And for listeners, a golden cross is just a classic bullish signal. It's when the short-term price average crosses above the long-term average.
It basically says the momentum has shifted from negative to positive.
Precisely. And you also saw a positive crossover on the MED indicator, which is another sign of bullish momentum building.
You have to add a word of caution here, right, with the RSI.
Absolutely. The relative strength index, the RSI, is up around 71. Anything over 70 is technically considered overbought.
Meaning it's run up very fast, very quickly.
And it might just be due for a little breather, a little consolidation before it can move higher. So the trend is strong, but it might be a bit stretched in the short term. But all of this, the technical strength, the operational story, it's all being turbocharged by the single biggest catalyst of all, which is M&A.
Mergers and acquisitions. This is the news that has everyone on the edge of their seat. We knew the company was in a strategic process.
And then the news broke on December 4th. The reports are that Netflix has won the bidding process for the studio and streaming assets.
And the reported price is huge, $30 a share.
A $30 per share offer. And when you look at where the stock is trading now, around $24.50.
That's about 22% instant upside right there. It's a massive premium.
It is, and it really simplifies the investment case. You're basically making a bet on that deal going through at that price.
But we have to talk about the what if. What if the Netflix deal falls apart? That's a huge risk.
It is, but this is what makes the situation so interesting. Management has a very strong plan B.
The fallback plan.
Yes, which shows there's value here even without a takeover. The alternative is the planned separation in mid-2026.
Where they'd split the company in two.
Right. You'd have global networks, the older, slower cable business, and then you'd have this pure-play, high-growth streaming and studios company.
And why does that unlock value?
Because right now, the slow-growth cable business is dragging down the valuation for the whole company. If you separate them, the market can put a much higher tech-like multiple on that fast-growing streaming and studio asset all by itself. So you've got a $30 takeover as plan A and a big value-unlocking split as a very solid plan B. Okay, but even with those two strong paths, we have to be critical thinkers and look at the big risks here.
And risk number one has to be the regulators looking at that Netflix deal.
It's a genuine threat. I mean, if you combine Netflix and Warner Bros. Discovery, their combined streaming market share could get close to 37%.
Which immediately sets off antitrust alarm bells in Washington and Brussels.
Big time. So deal failure is a real high-stakes possibility.
Okay, and the second big risk is more operational. It's about that key metric, average revenue per user, or ARPU. We saw it drop 9% globally in the first quarter.
And that's a serious number, but you need to understand why it's happening. It's a direct result of their strategy.
Because they're expanding into cheaper international markets.
Cheaper markets, and they're pushing pushing the ad-supported tier, which brings in less per user than the premium plan, so they're trading revenue quality for subscriber volume.
And if that pressure keeps up, it could really hurt their future revenue forecasts.
It could. So the question is, how are they fighting back against that?
The mitigation.
Right. And they're doing two things. Domestically, they're raising prices on the ad-free plans to get more from their most loyal customers.
And at the same time, they're getting much better at making money from the ads on that cheaper tier.
Exactly. Ad revenue on that tier was up 35% in Q1. Plus, things like the Max Disney bundle help keep domestic ARPU stable by locking people into a high-value package.
So when you pull it all together, the discipline, the incredible content library, the debt paydown, the M&A, it's a company really transforming itself.
I think the overall picture is pretty unique right now. They've proven they can actually make streaming profitable, which was the holy grail, while still having this monster $4 billion box office studio. That's a huge win, no matter what happens with any takeover talks.
Which brings us to the final thought for you, the listener. You look at the current price, and you see this potential $30 acquisition bid on the table. The upside is pretty compelling and asymmetric, because the improving business creates a solid floor underneath the stock. But, and this is a big but, the next few months really depend almost entirely on how and if those regulatory hurdles get cleared for that reported Netflix deal. That is the one variable that's going to dictate everything.
Make sure you subscribe to Smart Wealth with Joshua so you don't miss our next analysis.